Good afternoon, friends. I hope you all are having a good weekend. Now, this video, I'm going to discuss certain trap setups. Now, what's a trap? A trap is a place where people are stuck on the other side. Why, if you can identify traps, you have a large advantage because if everybody is trapped on the other side, you get very strong and sharp moves in your direction. These traps do not occur every day, but it's possible to look for them and trade them when they do occur. So let's start with the principle of these traps and how do you identify them. Let me start my whiteboard. Okay, now the first way a trap can be uh, made is that you have a market which is moving sideways. Now, most of you would know that the 20 period moving average, if this is a 5-minute chart or on a 15-minute chart or on a 60-minute chart, etc., would be flat if the market is moving sideways. Now, how is a trap set up? This is the sideways action. This 20-day moving average could also be a pivot of that time frame. So you have the intraday pivot on the 5-minute, the weekly pivot on the 15-minute, and the monthly pivot on the 60-minute. Now, where the trap is set up is the market goes up, comes down, and in this excursion is not able to go below either the pivot or the 20. So there were sellers here. There were buyers here. And the issue is if the pivot or the 20 stops the price, it starts to take out these sellers and hence the market starts to rocket higher. Okay, this is one of the ways. Now the same thing can be done on the downside. Again, sideways. This is the 20 period or the pivot zone. Finally, the market comes back to the pivot zone and collapses lower. So all these buyers who had their stops here, they get triggered and you go down. Okay, this is the second version of a trap. Now, if you have a market which is opening way above the pivot or in a sideways situation way above the range. So an example on Nifty would be that this is the day's pivot and the market has opened way above, maybe like 150, 200 points higher. So because pivots or the averages have the property of attracting the price towards them, chances are the buyers get trapped here and the market comes off maybe even for a day. Similarly, you open here and then the market starts to fail on you. Similarly, on the downside, you open on the downside and the market gets back into the range. Also, in an uptrend, you could have a gap down which finally goes back to the pivot. Now, 2 times out of 10, something different can happen. But those gaps are a bit milder. It is possible that the market gaps up after a sideways, comes down, retests the upper end of the range and then goes back up. This generally happens when there is great macro news. So in this case also, all these sellers get trapped. But if it's a gap up because US market has gone up or some such frivolous type of reason, then often the gaps close in. So this we'll have to see how the price action develops, but this happens only 20% of the time. Similarly, if you are in a downtrend and you have like a 200-point gap, some vaccine is being discovered, etc. Again, this will go back towards the pivot zone. So these are the ways markets get trapped. Okay, let me tell you a couple of more ways how markets can be trapped. See, you have a rising pivot which happens in a market which is going up. The next day, obviously the pivot is again higher. The market gaps down below the pivot and starts to break down. And all these guys who are long here, their stops get hit. Okay, we'll go through several examples, but let me just first tell you the ways in which you can have these traps set up. In a downtrend, you have these pivots which are coming down, and all of a sudden the market opens above the next day's gap and starts to move up. This can happen because global markets were in a downtrend and they have reversed, or the Fed has announced some things. Because of all these reasons, these things can happen. So these are the ways in which these traps can be set up. Watch this part of the video again so that you have a nice handle on what you need to look for. Okay, now let's go to the chart and see how these pivots work. Now let's go to this place recently where the market was sideways between 10,350 and 10 170 thereabouts. This was like last week. So here you can see that we are sideways. Okay. So this is the range. Now look at what happened here. The market was doing up and down in this range, and all of a sudden it comes back down and holds its pivot and then starts to reverse and has a sharp rally. Let's look at another way you can get a trap. Like I told you, if you gap up into the upper end of a range and the market starts to fail, you can reach the other end and again people get trapped at this zone. Similarly, you gap down here and the trap led you to move higher. Okay, so each time you gap into the boundaries of a range, a trap is set up. Okay, clear these drawings. Okay, now here again let me draw the range. So basically this is about 9600 to the 9950 range which we had for some time in the last month. Again, you can see we opened 300 points gap down, and from there the market went back higher. A day later, we opened 200 points higher and the market collapsed to the lower level. So as you can see, this way you can have traps where people are positioned on one side and the market starts to fail. Now look at this uh, bar. This opened at 10,300 and started to fail and collapse to the 200 period average or the pivot zone. Okay, so this way, when you open way above, pivot zone, you tend to trap people on one side. Okay, let me show you. See, traps are set up when ranges are turning into trend and trends are turning into ranges. Again, at this 91, 50, 70 zone, you can see the market first went down, immediately reversed, and once we took out this upper boundary, all these guys who were short here, they got trapped, and hence we started a large June rally from 8,800 to 10,300. Okay. So uh, also gaps can reverse trends. This is our package day high. This one here. And as you can see, it failed and it reversed a small uptrend that was taking shape. Basically, this was range bound and it opened way higher and then started to collapse towards the pivot zone. So most of the time, when you have these extreme gaps, they tend not to have follow through and are basically given up on the other side. So what are the different ways of trapping people? The first way is gap up, gap down in a range. Second way is in a range, you start to hold the pivot, right? Look at this here, up, down, and suddenly you start to hold the pivot zone, okay? Third way is that you have a trend and that trend starts to get reversed with a gap. So as you can see, this is a gap here, goes and touches previous day high and then collapses back. So all of these setups are trap setups. Okay. So very easy to find out. They don't happen every day. When they happen, there is generally advanced information. Obviously, you will enter a trend if you are sideways. Okay. And if you get a 200, 250 point gap up, the risk reward is extremely in your favor. If you are having a sharp downtrend, finally, for many days, 5, 6, 7 days, generally these trends get exhausted with a gap. So again, out there, you have to be aware about the other side. Like, as you can see, this correction got exhausted at 95.50. Okay. So most of these trends, they end up with a gap higher and then they collapse back towards the pivot. Now, one more thing I would like to mention. Please be aware that most of these gaps or these traps, they happen where you have a higher time frame support or a resistance. We turned from 95.50. Why? Because it was the package day high. Okay. We turned from 10,300 last time because there was a gap on the daily chart. We turned from 10,540 because it had a 200 EMA on a 200 EMA on the daily chart, I believe. So if you are looking at a gap up, gap down situation and it coincides with a higher level resistance, chances are it works much, much better. Okay. So just go back, have a look of where things are turning from, and the more confluence you are able to get. See, this is the hourly chart. Okay. So hourly chart, let me draw some levels and you will see what happens. This is your hourly chart. Okay. Again, at the top end, you had this 10,330. Okay. Now here, this was package day high plus the level at 95.50. So as you can see that often gap up, gap downs or trend reversals happen from a longer term support or a resistance. We can have a look at the Bank Nifty chart as well. This is the hourly chart on Bank Nifty. So out here, you gapped up into this resistance and you came down collapsing. Again, out here, you can see some amount of resistance is forming and you came down collapsing. Here, you gapped down into the support and you went up. Again, this is that 95.50 sort of zone. You gapped down here and you started to move higher. This was the gap support that we had when this occurred. Similarly, out here, this was the Chinese LAC excursion. This again worked out because the market fell very sharply into this support. Now, as you can see, this is the package day high, and again you had a fairly strong collapse from those levels. Okay. Similarly, here the market almost held on to its pivot and started to move up very, very sharply. So these are the zones where people are trapped on the downside and the market just reverses and starts to run up. So this should not be very difficult to figure out once you know exactly what you are looking for. So I hope this gives you a few setups to deal with and can be used in stocks or indices, etc. Because traps, they work everywhere. But I would caution that please use higher level support and resistance when you are dealing with these sort of gaps. That should be it for right now. Take care, trade well, and please consult your financial advisor.